Okay everyone, welcome to tonight's webinar on FNSACC601B Prepare and administer compliance tax returns for legal entities. My name is David Parasol and I'm one of the trainers in the accounting and finance strategy of Open Colleges. So if you do have any questions as we go through the material today, please feel free to ask some questions and stop me. Okay, just bear with me a sec.
We'll get back into it. Basically, the aim of today's webinar is to give you guys a bit more assistance and support with the content of this unit. It'll also help you with some of the other taxation units, which for anyone who hasn't yet completed those, you'll find very useful. And it also gives you an opportunity to ask some questions about the content in the unit or any of the other material, again, from a taxation side of things. The agenda itself is we're going to go through a couple of the key topics from the unit. These topics have been selected to specifically assist you with some of the assessment activities and also some of the key learning outcomes from the unit. And as we said, you'll also find a lot of these particular topics do help you through FNSACC 502B as well. The general guidance to note is that always remember that tax is not black and white. It can also be grey. And what that means is when you're going through activities, when you're going through your assessment questions, don't just jump to a conclusion without considering all of the issues present in those questions. Try to use the case study facts when you're responding to activities and assessment tasks. And before completing and submitting your assessments, it's really important to have read and understood the unit content. So if you do have any queries or concerns, you're obviously welcome to post an email through to your trainers and assessors, and also to have a look at the forums and see what other learners before you have actually picked up. When you're attempting the activities, if you are uncertain of yourself, have a look at the textbook or any tax book like the Master Tax Guide. Use the ATO website. As we just mentioned, ask questions of your tutor and ask work colleagues if you can as well. Now, before completing and submitting your assessment, make sure that you do go through and make sure you're familiar with the fundamentals of the Australian tax system, specifically related to individuals as well as entities, because by understanding some of the taxation issues related to individuals, that will help you when you're going through and looking at companies, trusts, partnerships, super funds, etc. Now, be aware of the fundamentals of calculating taxable income, the assessable income, less allowable deductions. Be clear on GST issues and FBT issues, and in particular, understand taxation structures and differences between them. Now, in any tax assessment, it's really important to make sure you do the following. Show your workings, number one, because we know you can calculate answers using eTax or any tax preparation software, but that doesn't show the assessor that you actually understand. So it's actually more important that you do understand the calculation steps than sometimes the final number that's actually calculated. Look at all inclusions and exclusions in calculation questions. So if you haven't included a figure, make sure you've just noted not assessable or non-deductible, or just it can be a couple of words just to say this does not impact my calculation. And with theory responses, explain your answer and make sure you give more than just a yes or no response. In this particular unit of assessment, the performance criteria include, number one, identifying taxation requirements for complex lodgements and returns. This particular unit of competence wants you to review and understand the differing tax requirements of the various taxation structures. Second point is to gather and analyse taxation-related data. It's really important to be aware of reports and information required to generate relevant taxation elements. So what that ultimately means is that you're starting with financial statements and then you've got taxation adjustments that need to be considered. The third point is to process data and prepare tax returns and lodgements. Once again, you'll find that with some of your activities and assessment questions, they are based on completing fields or areas of the various tax returns that are required. And finally, to review taxation lodgement compliance. And this unit really wants you to be aware of things like timeframes, what should be authorised for lodgement, and ensuring appropriate procedures and systems are maintained. So there's just a couple of key points to note. In relation to the required skills and knowledge for this unit, just a couple of points to note. I'm not going to read through the entire list, but obviously one of the key things, communication skills that are required to determine and confirm tax preparation requirements, and just like you were dealing with real clients, to liaise with others, share information and provide advice and guidance. Some of the research skills that you need to be aware of: access and manage financial services information, access and interpret tax legislation, regulation and precedent, and then identify tax-related matters that can impact the client services and specific client-related transactions that are relevant to tax matters. Now, as part of some of the other skills, obviously literacy skills, numeracy skills, IT skills as part of the unit activities, learning skills, problem-solving skills. So one of the key things to note, it's thinking of yourself as an accountant having to process various income tax returns for clients and the understanding of the various differences between different entities' income tax returns, looking at legislation, understanding legislation, and being aware of some of those key issues required when completing tax returns. Some of the other things that you've got to be aware of: ethical issues, conflict of interest issues, confidentiality disclosure requirements. And in particular, as you can see, you need to be aware of key elements of Australian tax law relating to tax returns for companies, trusts, partnerships and sole traders. And then you also need to be aware of income tax issues for self-managed superannuation funds as well. You need to look at things like residence and source, related elements of international tax, assessable income, deductions, tax rebates, offset and tax accounting principles. Some of the specific knowledge that's required relates to GST, relates to taxation of individuals and basic entities, including partnerships, trusts and companies, and you'll see their taxation aspects of superannuation law. There's also some requirements on administrative aspects of taxes identified, and you'll see in the assessment there's a theory question that does take you through some of those administrative aspects. Rules addressing specific and general anti-tax avoidance, and then ethical and professional responsibilities of tax agents, including your obligations under the Tax Agent Services Act and the Tax Agent Services Regulations. The other thing to note is the critical aspects for the assessment and evidence that are required to demonstrate competency in this unit. Well, most importantly, as assessors, we're looking for you to be able to demonstrate knowledge and understanding of Australian tax law so that it can be applied to tax affairs. Access, interpret and comply with information on relevant legislation, statutes, regulations and ATO rulings. Provide taxation advice having regard to the facts and relevant law. Develop organisational procedures to meet compliance requirements. Gather and verify data to calculate taxable income. Apply organisational policies and procedures. And then finally, prepare tax returns for business entities. So as part of this unit, you're going to go into a range of taxation fundamentals, including those that specifically relate to taxation structures. And some of the specific questions you'll see relate to assessable income and allowable deduction inclusions, FBT, and specifically in relation to car fringe benefits, GST and actually completing a BAS form and the required fields, some of the capital gains fundamentals, dividend imputation credit, and then finally down the bottom, structure issues that include partnerships, beneficiaries and trusts, company taxation issues, and then finally a simple superannuation fund. And we'll be covering a lot of these topics in the session today. So if you do find that you have any questions as we're going through a topic, please feel free to post that through. Now remember, there are actually two assessments to be completed for this unit. One of them is 3125-301, which is assessment case study questions, and the second one is assessment 22140B01, which is actually a research project, and there are two parts to that research project that you need to be aware of. One is around FBT, and one is in relation to a company that you work for or a company that you do some research on to answer a range of specific questions. Assessment 3125301 is worth 100 marks, and the assessment includes a range of scenarios on various taxation structures and issues related to those structures, and the assessment includes both theory and calculation components. As we just mentioned, the second assessment's also worth 100 marks. Two parts to that assessment. One is an FBT research assessment, and the other one is a business research project where you're basically looking at everything from taxation matters for that organisation to things like corporate structure, budgets and forecasts, and a range of other aspects of the operations of an organisation. This webinar has been prepared to offer some additional guidance and assistance for some of the core areas of the unit. So as we noted, please feel free to post any questions through the webinar, and I'll leave a bit of time at the end to answer any other queries. But please note, we just have to wrap up a few minutes early because there's another webinar straight after ours. The aim of the session today is to help you understand key concepts related to identifying assessable income and allowable deductions, to review GST issues and preparing a BAS, to look at the fundamentals of CGT related to structures, look at the fundamentals of the dividend imputation system, and then look specifically at the different tax structures and issues related to each. We're going to start with some of the fundamentals of Australian income tax, and that relates to the basic formula to be aware of, that assessable income less allowable deductions equals taxable income, and that taxable income multiplied by the applicable tax rate less any credits, rebates and offsets that are applicable gives you the net tax payable. Now, a common mistake that gets made, and I do see it in the assessments as well, is that tax offsets and rebates are treated as an income tax deduction, reducing taxable income. Please be aware that's not the case, and any credits, rebates or offsets that you do see ultimately reduce tax payable, not the taxable income for the taxpayer. In relation to any assessment questions, make sure you're clear on what is an allowable deduction, such as car or travel expenses. That reduces taxable income. And remember, what is a tax offset or rebate, like a low income tax offset or a mature age worker tax offset, reduces tax payable. So please be aware of that clear distinction. Deductions reduce taxable income, and the offsets and rebates reduce tax payable. Now, a couple of basic things to be aware of. Always consider things like the cash and accrual basis. Cash basis, where income is assessable when received. The accruals basis is where income is assessable on the invoice or at the time of receiving a bill. It becomes deductible. Now, in the courts over the years, there are four categories primarily of cases that the courts have dealt with: income from personal exertion, income from business activities, income from isolated transactions, and income from property. So what you always want to consider in certain aspects of tax is there may be something in legislation that's not clear. And if it's not clear in legislation, there may be a case or a ruling that has some impact in respect of the financial transactions or the income transactions. Now, remember that general deductions are deductible under Section 8.1. Specific deductions become deductible under Section 8.5. The key thing to remember is the expenses need to be incurred in gaining or producing assessable income. So Section 8.1a, which is the positive limb, and then expenses need to be necessarily incurred in carrying on a business that's gaining or producing assessable income, Section 8.1b, which is the negative limb and specifically relates to business taxpayers. The next point to note is in relation to your allowable deductions, losses or outgoings are allowed as deductions when they are incurred in gaining or producing assessable income, which is the positive limb, and that they're necessarily incurred in carrying on a business for the gaining or producing of assessable income. So if you're carrying on a hobby from home and you're selling a few things on eBay and you're incurring some costs related to that, those expenses would not be deductible because the business activity is not in respect of gaining or producing assessable income, but it's a hobby. Now remember that deductions are not allowed when they're capital, such as the purchase of land, when they're private or domestic, like paying for a holiday, when they relate to earning exempt income or non-assessable non-exempt income, and in those cases the deductions against that type of income cannot be claimed, or finally a specific provision prevents the deduction, such as any fines or penalties. Now, one of the specific deductions to always be careful of in tax relates to capital allowances or depreciation. Now, one of the key things to note is that in respect of the calculations themselves, one simple thing to be careful of within the units, always watch the date of acquisition. Now, one key point we've just raised on the slide here basically says that when a taxpayer is carrying on a business and is considered to be a small business entity, which basically means they're carrying on a business and they have turnover of less than $2 million, they can immediately write off assets that cost less than $1,000. Now, you've got to be very careful here because this is still a proposed reduction from the $6,500. It's tied in with the changes with mining tax and carbon tax. But for the year ended 30th of June 2013, it was the $6,500. The legislation is supposed to be amended from basically the 31st of December 2013. So watching the date of acquisition of assets does become an important part, but also be careful of what year the assessment wants you to calculate any capital allowances or depreciation. Now, going on from there, the next little area, or the main methods of claim I should say, with capital allowances relate to prime cost or the straight line method. So in that case, the asset is written off over its useful life. So if the asset was acquired for $10,000 on the 1st of July, so on the first day of the year, all you do is have to divide that by 5. Remember that if the asset was acquired on the 1st of January, then you've got to basically divide that by 2. There's only going to be 6 months of claim for the prime cost method. With the diminishing value method, basically what you're doing there is the formula is 200% divided by the useful life of the asset. So in this particular case, given it's 5 years, the diminishing value method in year 1 is $4,000. But one key thing to note with diminishing value method is at the end of the year, your written down value is $6,000, and when you do the calculation in year 2, it's $6,000 multiplied by 200% divided by 5. Very clearly here, we've taken the view that when you're reviewing your asset purchases, always pay close attention to the date of purchase, because the write-off is based on the number of days the asset has been owned. So if the asset was acquired on the 1st of March, the asset would only be for 122 days. So under the prime cost method, it's $668, and under the diminishing value method, $1,337. In an individual's tax return, there are specific things that are denied as deductions, and these include things that are private or domestic, like childcare fees or clothes for your family, expenses relating to income that is not taxable, and as we mentioned before, like having a hobby, and then expenses that are specifically non-deductible, like parking fines or entertainment. So there are things that are denied as deductions based on legislation. Now at this point in time, are there any questions that anyone would like to ask? And if you do want to ask at this point, just feel free to type it into the chat box. I can then see the questions and respond to them for you. And if there's any other queries at the end of the session, I'll open up so that you can also ask those questions at the end, and I'll unmute some of your lines. GST is the next topic on the agenda today, and in Australia, GST is charged on the supply of most goods and services. For example, if we supply goods or services, if we supply a right or we sell certain property, GST of 10% is charged. Now remember the registration thresholds. The general registration is $75,000. For a not-for-profit entity, that threshold increases to $150,000, and the taxi industry must register for GST. So just to be aware of that, that's another important point. Okay, just a general question, is the webinar going to be held again? One thing, we will be holding it again, but also the recording of the webinar should be posted online for you as well. So if you want to send an email specifically through, you want to get it in advance, please feel free to get in touch, and happy to obviously get that to you. So if anyone has an issue or does need to leave a bit early, just feel free to note that you will be made available a copy of this particular webinar. Also note that in relation to GST, you're required to keep documentation or records, anything that's above $75 plus GST. So receipts for $82.50 you're meant to maintain so you can actually claim input tax credits. So the next point to recognise in relation to GST is that most goods and services are subject to GST. They're considered taxable supplies. But there are also supplies that are not subject to GST, and these are referred to GST-free supplies and input tax supplies. Now remember, where supplies are GST-free, no GST gets charged, and it's important to note that GST-free supplies are to be reported on the BAS at G1 and then removed from the BAS at G3. So it's always important to note that when you're preparing one of the assessment activities, just be careful of GST inclusive, GST exclusive and GST free input tax supplies. Expenses are G10 and or G11, and one thing you can always do to help you with GST is you can use the GST calculation worksheet, which assists with your calculation because it adds additional boxes to what's actually on the BAS. So if you feel it would be more useful to use that calculation worksheet, you can download one from the ATO website, and I'll take you through an example shortly. Now, in terms of the input tax supplies, again, you don't include GST and you can't claim GST credits for purchases of goods and services that you do use to make your input tax supplies. The most common input tax supplies are financial supplies like interest income and selling or renting out residential premises. They're examples of input tax supplies. Financial supplies, interest income, when you rent out a property, that's actually not considered a financial supply, but it's still an input tax supply, which means in simple terms you don't charge GST on residential rent. Now with financial supplies, when you're lending money or you're providing credit for a fee, they're classified as input tax and do not attract GST. From a residential point of view, you also don't include GST when you sell or rent residential premises. One thing to be careful of, though, is the sale of new residential premises and the sale or rent of commercial residential premises are not input tax supplies and do have GST charged, provided the entity that's actually doing the sale is actually registered for GST. Now, it's always a good idea to think about the methodology behind taxable supply and GST collected, and that's known as the screen methodology. And basically what that says is supply, have you made a supply? For consideration, is the entity registered or required to be registered for GST? Is the enterprise supplying the course of the business? Connected with Australia? And finally, it's not GST free or input taxed. So when you're going through any income items, it's always a good idea to consider that screen methodology. On the other side of the fence, for expenses that have GST on it, you look at creditable acquisition. and that's the craft method for GST paid. Once again, consideration, registered or required to be registered, acquisitions made for a credible purpose, and then finally, was the supply an actual taxable supply? So let's now take that understanding into a little GST example, worked example, and you'll find there's a couple of points here to help you identify where the information goes in a business activity statement. So we've got a company called APE Medical Proprietary Limited. They had the following transactions, and they're a medical services company offering a range of activities, some attracting GST and some do not. For the 3 months to 30 June 2014, the following information's been provided. So you've got income of $100,000, which is inclusive of GST, but there was $34,000 of medical services income, and medical services income is an example of a GST-free supply. The total expenses incurred were $50,000 for GST inclusive expenses, which included $15,000 for medical supplies and $2,000 in bank charges. So the $15,000 of medical supplies are GST free, and the $2,000 in bank charges is an input taxed supply, so once again there is no GST. There was also a computer purchased for $22,000 including GST. So in the 2014 financial year, looking at the particular transactions, you can see at G1 we put $100,000. That's the total sales in the quarter. At G3 we put $34,000, which are the GST-free sales. At G10 we include the computer purchase, so capital purchases go at G10, that's $22,000, and non-capital purchases are $48,000. Now, there is always an argument to say that you include the full amount including the bank charges of $2,000, but one thing when you call the ATO and ask them about this, sometimes they say you don't need to include it because it doesn't get excluded anywhere else in the BAS form. And I'll go through where it would go in the GST calculation sheet as well. Now, GST-free or input tax purchases G14 is $15,000, and note that figure is actually no longer on the BAS. We've pulled that out from the calculation worksheet to help identify the simple fact that only $33,000 of the expenses do include GST. So GST collected of $6,000 from the $66,000 including GST, and GST paid of $5,000. Remember, that's the $2,000 from the capital purchase plus the $3,000 from the non-capital purchases. So the net GST in the quarter is $1,000. There's a little note there to say normally G1, G10, G11 are the GST inclusive figures, and there is a box on the business activity statement to tick to note that they are the GST inclusive figures. So here's an example of the calculation worksheet, and just to highlight for you that if we were to include the $2,000 of bank charges, that would go at line G13. So your G11 figure would increase to $50,000 and G13 would bring in $2,000, so you would have obviously a different figure in total, but you would still have the same GST paid on the expenses. So $6,000 collected, $5,000 has been paid, and therefore the net amount to remit is $1,000. So that's a little example from a GST perspective. So if there's any questions on GST, now is a quick opportunity to ask. Hand up. So let's have a look at a particular question. Okay, so what is the question in respect of GST? So feel free to just type in any questions that you may have, and if the question does relate to the topic itself, you can post it at any time because I can then see the questions from you. So if you want to, anyone, I can see there's a hand up there, so would you like to ask the question? What I can do very quickly is I can see. If the hand is just there and you want to take it down, that's fine. I'm just if you do have a question, feel free to ask now. Otherwise, I can take the questions at the end of the session if you like. Okay, well I'll just, for the time being, I'll just lower the hand, and if there is any questions later on, please feel free to type them in at any stage. The next topic we're going to talk about is FBT, and from an FBT point of view, okay, just having a look, it says there's an unanswered question. I'm just trying to see. So the question says is if it's below $75, you don't need to keep it. That is actually correct, that if you have another record, so perfect example, if you pay something for $40 on a credit card and you've got the credit card statement, and on the credit card statement it says $40, you actually don't need to keep the receipt. So the threshold is $75, and in actual fact it's $82.50 plus GST, $82.50 including GST. So if you do have any receipts that are below that threshold, no, you don't need to keep it. As long as you have a record of it, so you can certainly record in the system, you actually don't need to keep the receipts. All right, so we'll move on to FBT now, and fringe benefits tax is basically paid on certain benefits that employers provide to their employees, associates, to replace or in addition to standard salary and wages. So I'm assuming some of you in the past may or may not have been entitled or received fringe benefits, but remember that the fundamentals of FBT is that for the year ended 31 March 2014, so we'll call that the previous year of FBT, the tax rate was 46.5%, and some of the major types of benefits include the provision of a car, expense payment benefits, meal entertainment, or loan fringe benefits. Now, note that the following year, 31 March 2015, the FBT rate does go up to 47% because of the change in Medicare levy of an extra 0.5%, and for some it may even be the 49% given the surcharge of 2% that's been added for high income earners. Now, very simply, when it comes to FBT, it's always important to work through some steps. And really, before you get into the calculation itself, you look at points 1, 2, 3, and 4, and they're the theory behind FBT. The first question to always ask is, has a benefit actually been provided? The second step is, has the benefit been provided to an employee or an associate of the employee? So remember that if it's your husband or wife, or even a child potentially, they're an associate of the employee, but it is the employee who has the fringe benefit consequence. But you can certainly, for example, package a car for your partner as well. Has the benefit been provided in respect of employment? And then finally determine what type of fringe benefit provided was. 5, 6, 7, and 8 are the calculation elements. And when it comes to the taxable value of the fringe benefit, one of the key things to note is look for any exemptions or reductions to the taxable value. What that means is, let's say that your employer pays your professional membership fees. Well, let's say that you currently work in an accounting firm and your employer pays for this particular course, then that would be considered to be otherwise deductible and fringe benefits would not apply. There's also a minor benefits exemption, so if you receive a once-off benefit of less than $300, once again, no fringe benefits apply. And if you work for an employer who provides you with in-house property fringe benefits, anything less than $1,000 is once again exempt from FBT. After you've determined that, let's say, the $1,000 was the taxable value, you then calculate the gross taxable value of the benefit and look at is the benefit a type 1 or type 2. What that means is type 1 is a GST inclusive benefit, and a type 2 is the benefit's GST free or the entity is actually not registered for GST. So very simply, GST inclusive, for example, gym membership. Okay, pay GST on a gym membership. GST free might be for private health insurance where there's no GST. You then take the GTV, the gross taxable value, multiply by 46.5%, work out your FBT payable, and then finally prepare and lodge the FBT return. There are 13 types of benefits, but for the purpose of today and the purpose of the assessment, the main benefit required is a car benefit. For the second assessment, you do need to do a little bit of research on some of these other benefits. So I just thought I'd list them there for you. Some of the things like loan benefits, expense payment benefits, a housing benefit, a board benefit, meal entertainment, and property benefits as some other examples. We're going to focus on cars today because that is what is in your assessment. And remember that a car fringe benefit arises when a car is held by an employer and is made available for private use by an employee or an associate of an employee. Note there are currently two methods of calculating car benefits, and the method selected is the one that provides the lowest FBT to the employer. So you can choose, if you've got a logbook, which method to use. Note that there are also exemptions to car benefits. Vehicles that are taxis, panel vans, or utility vehicles designed to carry 1 tonne or less are all exempt from FBT. We'll start off with the operating cost method because that's actually the more complex calculation method. Because what you need to do in this example is, number 1, look at and calculate the total operating cost. Number 2, you must have a logbook or a business percentage of the car during the holding period per the logbook. So let's say that it's 25% private, and R is any employee contributions to the fringe benefit. Now step 1 is to total the expenses incurred like petrol, repairs, insurance and registration. So all the running costs of the vehicle. Then what you need to do is add a calculation for deemed depreciation expenses. So in this case you would use the opening written down value of the car multiplied by 25%. So based on the date of purchase, we'll determine whether it's 25 or 18.75, but today 25%. You then add a figure for the deemed interest, which is, again is the opening written down value of the car multiplied by the FBT interest rate. So for example, 6.45%. You then add steps 1, 2 and 3 together, and let's say that totaled $12,000. You multiply that by 25%, so you end up with $3,000, which is the taxable value of the benefit provided. A couple of things to note, these are the dates that are relevant in terms of the depreciation, and basically any car acquired after the 10th of May 2006 is now at 25% for any FBT return after 2009. Remember that the deemed interest rates do change every year. So it was 7.4, dropped to 6.45, and I think it's gone back to 6.8% in 2015. The statutory formula method is a much simpler method, and in particular it's much simpler today if the car's been acquired after May 2014, where the statutory percentage is just 20%. So to work out the taxable value, you've got the cost of the car, which excludes stamp duty but includes GST. So just remember that point. You get a 2/3 reduction if the car's been owned for more than 4 years. So if the cost was $30,000, you multiply that by 2/3 when calculating the taxable value. You then work out the statutory fraction, which is based on the kilometres travelled, but as we just noted, 20% is more than likely if the car was acquired after May 2014. You take off the number of days the car was available for private use. So if the car was stationed in the office and the keys were left with the employer, you take off those days and it's not subject to FBT on those days. You then work out the number of days in the FBT year, which is either 365 or 366, it's a leap year, and remove any employee contributions. So, as we just noted, there were some transitional rules that came in 2011, and basically, my apologies, from the 1st of April 2014, any car that was acquired after that time is just 20%. So it does not matter how many kilometres have been travelled, the statutory formula is 20%. Prior to that, you could have 20%, 14%, 10%, 17%, a range of different rates. You can see there over time it penalises people who don't have a logbook, to be honest, if you're driving a lot of kilometres. Here's the example just to highlight how to do the calculation. So we've got KLC Engineering, employs 20 staff. 2 employees are provided with cars as part of their salary package. Vehicle A was acquired on the 1st of April 2013 and provided to an employee. The following costs were incurred for the FBTU ended 31 March, and that is fuel of $25,000, repairs of $600, and insurance of $1,100. It notes that a logbook has been kept for a continuous period of 12 weeks, showing a business percentage of 60%. Now, going forward from there, vehicle B was also provided to an employee. The vehicle was acquired on the 2nd of January 2013 for $50,000 and travelled 22,000 kilometres during the FBT year. In June, the employee went overseas for the month and left the car, including the keys, at the office. So in doing the calculations for these vehicles, one of the key things to note is vehicle A, we need to look at a deemed depreciation calculation. So in this case, we've got 25,000 by 25% gives you $6,250. Deemed interest of $25,000 multiplied by 6.45% gives you $1,613. Add the other costs together of $6,700. Gives you a total operating cost of $14,563. Taxable value then, we take the private percentage of 40%, so $5,825 is the taxable value. For vehicle B, the car travelled 22,000 kilometres in the year, therefore use the 20% rate. The taxable value here of $50,000 by 20%. So it hasn't been owned yet for 4 years, therefore it's not a reduction. Multiplied by 335 divided by 365 days gives you a total of 9,178. You can see that because the car was not available for private use for 30 days, the car is not liable for FBT for those 30 days. And as you can see there, you're using the GST inclusive amounts, which is used to calculate FBT. So that's the FBT side of things. You'll find that when you do go into the assessment, there is a question on FBT in there with some facts that you do need to consider similar to what we've just presented. Let's move on now to capital gains tax. Now, one of the key things to always remember about capital gains is when the tax actually started. So it commenced on the 19th of September 85. So if you bought a property in July 84, and sold it in the current year, it's not subject to CGT. Remember that CGT is not a separate tax, but the net capital gains are included as assessable income in an income tax return. And CGT is a residual taxing mechanism, so the provisions only apply where other provisions do not. So you've always got to consider the use of ordinary income provisions before capital gains tax applies. Now, when you're working through CGT events, it's always good to just work through a very simple flowchart that notes simple questions to ask. And the first question is, did a CGT event actually happen? So you sold a property. Yes, a CGT event happened. Does an exemption apply? No. Do the capital proceeds exceed the cost base? And does the reduced cost base exceed the capital proceeds? So the reason you ask these questions is if you need to determine whether, firstly, there is a capital gain, whether there's any exemptions that may mean you disregard or reduce the capital gain. If the capital proceeds are greater than the cost, the excess is your capital gain. If the reduced cost base exceeds the proceeds, the excess is your capital loss. So from a timing point of view and the understanding of those CGT events, always pay attention to the cost base, to the proceeds, and to the dates of the transactions themselves. So there's two main methods of the calculation. Number one is the indexation method. And to use the indexation method, the asset would have had to have been acquired from the commencement of GST in 1985 to the 21st of September 1999. As soon as the asset is acquired outside that date range, you cannot use the indexation method. The discount capital gains method, you can use it for individuals, trusts and super funds. Although with a super fund it's only a 1/3 discount, not the full 50%. And you have to have owned the asset for at least 12 months or more for the discount to apply. This is applicable for CGT events that have occurred after the 21st of September, but you can always calculate both and look at which gives you the better result. So, number one, you always try and calculate both where you can and use the one that gives you the lowest CGT, and always watch your dates of acquisition for those events. So there are two methods of CGT, the indexation and 50%. So as we just noted, use the one that gives you the lower capital gain. So let's take that into a simple example and basically highlight Sam's particular transactions. Now, Sam bought a house in September 1992, so that is after the date of CGT commencement, so there will be CGT. He incurred $10,000 on capital improvements and he sold the property for $800,000. So the question is, calculate the net capital gain and what CGT concessions would be available to Sam. If the gain was made under a company, what would the gain be? And if the gain was made in a super fund, what would the capital gain be? So this is designed to say, look at who the entity or the person is that's selling the asset, because there's going to be different capital gains consequences in each one of these three examples. Let's start with the easy one. Sam the individual. The basic capital gain would be $390,000. So $800,000 minus the $410,000 gives you a gain of $390,000. But if you apply the indexation method, your capital gain is only $195,000. For the indexation method, you need to use 1234, so it's 123.4 is the numerator, and 107.4 is the denominator. So 123.4 is always on top in the calculation, and then you divide that by the index factor in the period of the cost. So it's quarterly indexation factors. So you can see there the acquisition cost indexed is 459,590, and the capital improvement uses a different rate and it grosses up to 10,759. The net capital gain is 800,000 minus that 459 minus that 10,700 to give you a gain of 329,651. So in this example, the discount method clearly gives a lower capital gain. Going on from there, in a company, once again the basic capital gain would be $390,000. But a company cannot use the 50% discount method. So only the indexation method can be used. And in this particular example, the capital gain is the indexation method capital gain. So the 329,651 is the lower capital gain because 50% discount does not apply. For a super fund, in this particular case, we can use the 1/3 discount when the capital gain is made. So the $390,000 reduces to $260,000. So just to be aware of that, a couple of points to recognize in the context of the calculation there. Now, just trying to get through, is there another question that's just been asked? Just trying to have a look. Little example to note. Okay, So, sorry, my apologies, there was another question. So, any property acquired by an individual before July 1999 is only allowed to use indexation? No. The simple rule is for an individual, you can use the indexation method or the 50% discount method. So, based on the qualifying date of 1999, if it's purchased between 85 and 99, then you can either use the index method or the discount method. So, hopefully that answers that question for you. So you can certainly use both, and you'll certainly find that 99% of the time the discount method usually gives you the better result. Now, next question. Can capital losses be offset against other taxable income? The simple answer is no. They get carried forward to be offset against other capital gains in the future. So just to be aware of that, once again, capital gains can only, or capital losses I should say, can only offset against capital gains. When you're calculating net capital gains and losses, your net capital gain is the total capital gains for the year, including those that come directly from things like managed funds or other trusts, minus total capital losses, including any net capital losses from previous years, minus any discount and small business concessions that you might be entitled to. So always work through the steps, look at each individual CGT event, calculate that through and show your workings when it comes to assessments. A net capital loss, so if your total capital losses for the year exceed your total capital gains, your net capital loss is total capital losses, including any net capital losses from prior years, minus your total capital gains for the year, including those distributed by a managed fund or trust. And note that you can't deduct a net capital loss directly from income, but you've got to carry it forward and then deduct it from capital gains in later years. So that's the capital gains tax side of things. If there's any further questions at this point from a capital gains perspective, feel free to ask now. Okay, so we'll move on then to the next topic, and the next topic is around imputation and franking credits. Now, in this particular topic, you'll find that this is a really important area to be aware of, because one of the common mistakes that we see in assessments is that we see a lot of learners actually don't include the franking credit as assessable income. So it is important to always remember that if it's a fully franked dividend, you get an imputation credit which is also assessable income. So I'm going to take you through to a little example, and one of the things you've got to do in this particular unit is you need to be able to prepare a franking account for a company. What is the franking account? It keeps records of all the franking credits and debits that arise within an income year. The franking credit arises in the franking account when the company pays its income tax or when it receives a franked dividend. A franking debit arises when the company pays a franked dividend to its shareholders or receives a refund of income tax that it's paid. Now remember that the franking account operates on a tax paid basis. So if a company pays tax of $30, the franking account is credited by $30. In addition, the franking account operates on a rolling balance, which means you've always got to bring forward the closing balance from last year is the opening balance for the current year. You can never have a debit balance at year end. It always has to be a credit balance. We don't have to go into it in this unit, but if you have a debit balance, you've got franking deficit tax to pay. Note that this topic is also very prominent in FNSACC601B as well, so you will refer to this when doing your other assessments there. Basically, what's the impacts of a franked dividend? Very simply, when a taxpayer receives a franked dividend, the franking credit is included in assessable income, and the taxpayer then gets a tax offset equal to that share of the franking credit. The taxpayer may be entitled to a refund if the tax offset allowed exceeds the basic income tax liability. So it is a refundable credit, which means if your income is only fully franked dividends of $100, then the imputation credit that you received or the franking credit you receive will be fully refundable. The other thing to note, if the franked dividend recipient is a company, the franking credit received will go into its franking account. So very important to be aware of that. So here's a simple example to have a look at the imputation system and franking credits. John receives a $500 fully franked dividend from ABC Proprietary Limited for the year ended 30 June 2014. John has taxable income of $714, considering of the dividend of $500 and the franking credit of $214. So how do you calculate that franking credit? Well, basically what you do is it's $500 dividend multiplied by 30 divided by 70 gives you the $214. So it's the tax rate divided by 1 minus the tax rate, or minus 100% minus the tax rate. John would therefore be entitled to a franking tax offset of $214. So that is the imputation system. Obviously, there's some good information in the unit on that for you, but make sure to simply remember, if you see a fully franked dividend, it grosses up and includes the imputation credit as taxable income. All right, the last major part of the session today relates to taxation structures, and what we're going to try and do is give you a little bit of guidance in respect of these taxation structures and talk about some of the key issues related to each one. So we're going to look at you running a business, and when you run that business, you can trade as a sole trader, you can trade through a partnership, you can trade through a trust, you can trade through a company. So in terms of the calculations for each one, there are different issues to consider in terms of the structure. You can also have a self-managed super fund to aid in your retirement. So we'll start off with a sole trader, or it's basically an individual in business. So you got this really great idea today that you want to go home and start a business tonight. And one of the things that you do is think, right, I don't have a lot of money, so I'm going to start my business as a sole trader. I'm going to register my business name, and I'm going to start trading tomorrow. The sole trader gets taxed at marginal rates, has a tax-free threshold of $18,200 for 1314, pays the Medicare levy of 1.5%, which was applicable up to 30 June 2014, but has now gone up to 2% in the 2015 year. Are entitled to tax offsets unique to individuals, including things like the low income tax offset, the senior and pensioners tax offset, which is known as SAPTO, and LITO. And then finally needs to substantiate deductions. Now you'll see a lot of the individual tax side of things in the other unit that we just mentioned before, which is FNSACC601B. Okay. So just to be aware of that, something to consider in that unit as well. So here's a simple example. Les operates a business as a sole trader. For the year ended 30 June 2014, he showed an accounting profit of $100,000 in his financial statements. Including that profit was an expense for $10,000 for a private holiday, $3,000 for a business trip, and $1,000 for a speeding fine. He also earned $5,000 in interest during the year. So the question is, calculate John's taxable income for the year ended 30 June 2014. So in this case, you start with an accounting profit of $100,000. Then you add back the fines because they're not tax deductible. The private holiday, once again, is non-tax deductible. The business trip is fine, so there's no tax adjustment required there. So his business profit is $111,000. You then add his interest income of $5,000 and ends up with taxable income of $116,000. So there's just some basic guidance when you're looking through an individual's tax affairs. Now the next structure we're going to talk about is a company, and the company is defined under section 9951 as either a body corporate or any other unincorporated association or body of persons, but does not include a partnership. Note that it can be a public or private company, but the Commissioner can deem a private company as if it were a public company, or deem a public company as if it were a private company. So very simply, a private company is normally limited to 50 members or 50 shareholders. Public companies obviously might be listed on a stock exchange and have thousands of shareholders. Calculate taxable income for a company is assessable income less allowable deductions multiplied by 30% gives you the tax payable. When you're calculating taxable income, you've got the taxable income, the tax on taxable income, less foreign income tax offsets, less any PAYG instalments, and also remember to take off the imputation credits that have been received in the company as well. So there's actually another one that's not on there. Foreign income / your imputation credits come off as well. Now, from a franking account point of view, a company is the only structure that has a franking account. So what you need to be aware of, and you certainly need to be aware of this for your assessment, is those transactions that create debits and credits to a company's franking account. This will actually determine what dividends, if any, can be paid to shareholders, franked or unfranked. So this is some examples of franking account debit and credit entries. On the left-hand side, so it's actually back to front, the franking credits and the increase to the franking account when you pay PAYG instalments, so when you're paying the pay-as-you-go company tax instalments, paying company tax on lodgement of an income tax return, receipt of franked dividends, or payment of franking deficit tax. So that's what we said before. You can't have a debit balance at year end, so paying that tax also acts as a credit. Some of the debit examples: tax refunds, payment of franked dividends, and underfranked distributions create franking debits in the franking account. So here's a simple example to highlight movements in a franking account that you need to consider when you're calculating through. So opening balance of $27,500, that's a credit balance. We then paid a dividend, which was only franked to 50%. And you'll see there we paid a $25,000 dividend, only 50% franked, so it's multiplied by 50 by 30 over 70. So if it was fully franked dividend, it would be 25,000 multiplied by 30 on 70, and that would give you the debit into your franking account. We got a company tax refund. Now remember that tax refund is a debit in your franking account. You've then got the PAYG instalments paid of 20,000, a dividend received from another company which is fully franked, a dividend paid of 148,000. Now just to note, that dividend received, that's the franking credit related to the dividend. So it doesn't actually note that the dividend was the grossed up amount, but the imputation credit is the $30,000. Dividend paid of 148,000, again franked to 50%, creates a debit. A PAYG instalment paid of 20,000, another dividend paid of 4,000, so you can see it's just the imputation credit that comes out, and then another instalment paid, so at the end of the year, $69,571. So again, lay out your franking account like this. You don't have to know the section references for this example, but I think it's always important to note there's only two section references that are relevant: 205.30 for debits and 205.15 for credits. So just to be aware of that. Again, the nature of that, I can see there very simply a couple of little mistakes. The dividend paid should be 205.30, and the other dividend paid should also be 205.30. So just a couple of things there, and the PAYG instalment should be 205.15. So just to be aware of that. But ultimately, the section references are not so relevant in your assessment. So that is companies, and again, one of the other structures that you do need to consider, and specifically think about the preparation of a franking account. The next topic on the agenda is a partnership, and for a partnership, it's basically defined in the legislation as an association of persons other than a company or a limited partnership carrying on a business as partners, an association of persons in receipt of ordinary income or statutory income jointly, or a limited partnership. The tax definition extends the meaning of partnership to basically say the relationship between parties carrying on a business in common with a view to profit. So remember that when it comes to taxation and partnerships, a partnership never ever pays income tax. Whatever the profit is of the partnership always flows to the partners. So there's no retained loss in a partnership, and the profits always have to go through to the partners in the partnership. So Andrew and Peter are equal partners in the AP partnership and each contributed $50,000 in initial capital to the partnership. The following information is provided: sales and services of $350, take-off cost of goods sold of $130, other expenses including wages of $120, and profit on sale of shares of $20,000. Wages for Peter included in other expenses was $10,000 in 2014. So the question is, calculate partnership net income and the partner's share of taxable income for 2014. So very simply, what you do is you start with the accounting profit of $120,000. So you're starting with that 120. You then remove the profit on sale of shares because a partnership never ever includes capital gains income. It goes directly to the partner's individual tax returns. Peter's wages also need to be removed, which is $10,000. The net income of the partnership then becomes $110,000. The distribution would then be as follows. So we've got $110,000. Peter gets his wages back because that might be incorporated into the partnership agreement. Then the balance remaining is $100,000. So Andrew gets $50,000 and Peter gets $60,000 of the net income of the partnership. Now remember, when you're calculating the individuals, you need to add on their share of the capital gain. So that's the partnership side of things. Is there any questions on partnerships at this point? Okay. We'll carry on at this stage and hit the last couple of structures. The next one is a trust. Now, from a trust point of view, it's always important, and if you're not familiar or haven't dealt with trusts a lot, one of the first things to always do is be aware of key trust element definitions. So who is the trustee? That's the person or entity responsible for the trust. Who is the legal owner of the trust property? What is the trust property itself, so the assets owned by the trust? Who's the settlor? The person who settled the trust, and often that might be the accountant or the lawyer who set up the trust. And then who are the beneficiaries and those that benefit from the trust income and trust assets? Now there are three different types of trust: discretionary trust, fixed trust, and unit trust. The focus here is really on discretionary trust and the understanding that the trustee can determine which of the beneficiaries are going to be entitled to the income of the trust. So it's important to understand and be aware of who is ultimately assessed on trust income. And in terms of the little flowchart there, this is basically designed to say, make sure that when you do your assessment, there is a question or there is a column, the taxable section is at section 97.1 or section 98.1 or even section 99 or 99A that is relevant to the income that flows to the beneficiary. So one of the best ways to understand trust issues is to literally ask yourself these questions. So number one, is the beneficiary presently entitled? Yes. Is the beneficiary under a legal disability? No. Is the beneficiary a resident? Yes. Then it's a tax and the section reference is section 97.1. If it's a minor beneficiary, then the trustee gets taxed and 98.1 becomes the relevant section reference. So now this little flowchart is just to point out down the bottom in particular the key paragraph references of legislation that are relevant to the beneficiaries of a trust and where the trustee might be taxed because the beneficiary is not yet entitled to the income. So let's take a little example to highlight trust income issues. And so we've got the Jones Family Trust. They are a discretionary trust. The accounting profit for year ended 30 June 2014 is $100,000, again including $2,000 in fines and $8,000 in non-deductible entertainment expenses. The trustee has exercised its discretion to distribute the income to the following people. So Sam is an individual over 18, he gets 50%. Jessica is an individual over 18, she gets 30. Joey's a minor, gets 10%, and Andy is a minor and permanently disabled, gets the balance. And it says to note all beneficiaries are Australian tax residents. So the question is, calculate the taxable distributions and appropriate taxation treatment for each beneficiary. So one of the key things to recognise here is that when you look and you can lay out a little table like this, remember that the net income for distribution purposes here is $110,000. The $100,000 plus $10,000, which is the non-deductible expenses, and that's what then gets distributed. So one thing to do when you're looking at the calculation, always watch out for tax adjustments between accounting profit and taxable income. So you can see there Sam gets 50%, so his share is $55,000. Jessica's entitled to 30%, she gets $33,000. Who pays the tax in Sam and Jessica's case? They're both over 18, and therefore it is paid by them personally. Joey is a minor beneficiary and he gets 10%, so he gets $11,000. The trustee pays the tax on behalf of Joey. And then finally Andy gets the balance of income. Remember, Andy has an actual disability, but once again the tax is payable by the trustee. So there's a simple example, and not to give anything away, when you look at your assessment you need to do something similar in terms of identification of some trust income issues. As a minor beneficiary, remember that the maximum tax-free distribution for Joey is $416, subject to the special tax rules. Any income above that gets taxed at the highest marginal rate. With Andy, although he's under 18, he's a minor with a disability. Therefore, he's excluded from the special tax rules. Any distribution from the trust would be considered as accepted income and taxed at normal tax rates. So always pay attention, ultimately, who are the beneficiaries? There's one simple thing to be careful of there. The last thing to cover today relates to self-managed super funds and the taxation of superannuation funds. Note that as an employer, you get contributions or make contributions of 9.25, which became 9.5 from the 1st of July 2014. Note that the concessional contributions cap was $25,000, increasing to $30,000, and there is up to $35,000 if you're over 60 years old. The non-concessional contributions cap, which is not assessable to the fund, and these are basically personal contributions made into the fund, so they are not assessable income when it goes in the fund. Remember that complying super funds are taxed at 15% and non-complying funds get taxed at 45%. Note there is a 1/3 CGT discount available, but the asset must be owned for more than 12 months. So one key way of remembering what to do with different types of income in a super fund is just to be aware of the treatment of different income types. So we've got employer contributions. So if you're currently working, you're getting your money from the employer being put into super. Is it assessable income to the fund? Yes. The tax rate's 15%. But if you personally put in superannuation to your super fund, it's not assessable to the fund, it's not deductible, and there's no tax on it. Self-employed contributions, on the other hand, are assessable income to the fund, but are not deductible. But are deductible to the individual, and the rate there is 15%. Spouse contributions, not assessable, not deductible, and then you get into some of the income types and expenses. So interest income, dividend income, remember that imputation credits are assessable, but also they're refundable as well. Accounting fees are deductible, audit fees are deductible, and note that PAYG installments are not a deduction, but they reduce the tax payable in the fund. So capital gains on assets held for 12 months or less, they're assessable, taxed at 15%. Capital gains on assets held for more than 12 months, again, are assessable, but the rate is reduced to 10%. So only 2/3 of the profit is actually included. So instead of paying 15%, basically you pay 10% on those benefits. So the last example for today relates to the Jones Family Super Fund earning a range of income elements. So we've got fully franked dividends of $22,000. We sold some shares for $100,000 that were acquired for $80,000 on the 1st of September 2013. And what that indicates is the period of sale is less than 12 months. He then also sold some shares, or the super fund sold some shares for $70,000 on the 20th of June 2014, and they were acquired for $40,000 on the 1st of July 2012. So when you look carefully at the dates, that is obviously less than, more than 12 months, and therefore the discount will apply. Interest income of $10,000 would be assessable. The personal contributions of $20,000 were made by Mrs. Jones. Personal contributions not going to be assessable in the fund. The employer contributions of $35,000. Accounting fees of $1,200, and then PYG instalments of $10,000 were paid. So the question says calculate the taxable income for the year ended 30 June 2014, and this is the example of how things would look. So start off by including the fully franked dividends of $22,000 with an imputation credit of 9,429. So 22,000 multiplied by 30 on 70, 9,429 is also added to the income. The capital gain on shares, which were held for less than 12 months, is the full $20,000. But the capital gain on shares held for more than 12 months is reduced from a profit or a gain of $30,000 to a gain of $20,000 because of the 1/3 reduction. The interest income of $10,000, the employer contributions of $35,000, take off the accounting fees, and you end up with taxable income of $115,229. So that's an example of a fund, but there are a couple of items that you still need to be careful of. Number one is personal contributions, which are not assessable income to the fund, and then PYG instalments, which are not deductible but reduce the tax payable for the fund. So there's those other elements that were in that case study, and as we noted up front today, always important to note down any particular non-deductible or non-assessable items, just so it's a complete assessment that you're submitting. So that is superannuation funds, and that is the structure of the business. Now, does contributing to your spouse super fund reduce your own taxable income? Well, this is a really good question, because does it reduce your income? No. Does it potentially give you a tax rebate or tax offset? Yes. Now, one of the other key things to be careful of is if your partner is a lower income earner, then there used to be some incentives from the government to put in self-contributions or put in some after-tax contributions. But in terms of does it reduce your own taxable income, the simple answer is no, it does not. So that concludes the formal part of today's session. Just a couple of final things just to note, and then I'm just going to open the floor for any other general queries. One of the key things to note, in any theory questions in your assessments, there's a range of different taxation issues to respond to. In some cases there are word counts to be applied, so the key is to respond to the issues and provide a brief explanation. Now, for most assessors, they're not so fussed about the word count, provided you get the key content included in your answer. Remember, they're tax assessments, so bullet point responses are fine. The key to success is to provide a conclusion to the question or issue, but then explain your response. So this is non-deductible because of ... is a really important thing to consider. So the last thing just to note there, and here's a little example. Jenny is employed as an IT consultant. For the year ended 30 June, she spent $200 on a training course on accounting software, as in her work she helps clients install accounting software. In assessing the tax deductibility, your answer should state, this would be an allowable deduction because the expense is directly related to her earnings or to her assessable income. So anything like that would be appropriate. You don't need a lot of words. You just need to make sure that you're clearly responding to the issues at hand. So, thank you for your attendance tonight. If there are any final questions, we have literally a couple of minutes left to take those questions. Does anyone have any final questions or queries they would like to raise in respect of today's webinar? Any final questions that anyone has? Oh, well, thank you. Just to note, the webinar should be posted online for you shortly. There'll be some extra resources posted with it as well. But if you do have any questions when you're completing your assessment, please feel free to email through. If there's any queries or clarifications required, you just want to check something before submitting, please feel free to email. And all I can say is best of luck with your assessments. I hope you get through them quickly and you can complete the course, but feel free to get in touch. And thanks for your attendance tonight. Good night.